Welcome to Ray Dalio Warning. Please like, subscribe, and share.
What if I told you that while you're busy watching stock tickers and checking your portfolio, two ancient metals are screaming a warning that could make or break your financial future? Gold just hit record highs. Silver is surging. And Ray Dalio, the billionaire who predicted the 2008 crash, says if you're missing what these metals are telling you, you're on the wrong side of history. The message is urgent. The consequences are real, and most investors are completely blind to it. Ray Dalio, the billionaire investor and founder of Bridgewater Associates, the world's largest hedge fund, doesn't issue warnings lightly. When he speaks, central banks listen, governments pay attention, and smart investors take action. Right now, in early 2026, Dalio is pointing to something extraordinary happening in the precious metals market. Gold has shattered through $2.100 per ounce. Silver is climbing alongside it. But this isn't just another commodity rally. According to Dalio, this is a signal, a message encoded in market movements that reveals the true state of our global financial system. In this video, we'll break down exactly what gold and silver are telling us about the economy, why Ray Dalio believes precious metals are flashing a red alert for traditional assets, and most importantly, what you need to do with your wealth right now to position yourself on the right side of this shift. This isn't about fear. This is about understanding the economic machine and using that knowledge to protect and grow your wealth in the turbulent years ahead. To understand why Dalio is sounding the alarm, you need to understand how he sees the economy. In his framework, what he calls the economic machine, everything moves in cycles, short-term debt cycles lasting 5-8 years, long-term debt cycles spanning 50, 75 years, and throughout history, when these cycles reach their breaking point, there's always a reset, a transfer of wealth, a restructuring of the financial order. Dalio documented this in his book Principles for Navigating Big Debt Crisis, where he analyzed over 50 major economic collapses across 500 years of history. And here's the pattern he found. Every single time a debt cycle reaches its peak, when governments have borrowed too much, when currencies are debased, when faith in the system begins to crack, gold and silver become the ultimate store of value, not because of superstition, but because of mathematics. Because unlike paper currency or digital entries in a banking system, precious metals cannot be printed, devalued, or inflated away by central bank policy. Right now, we're at a critical inflection point. Global debt has surpassed all $315 trillion. The Federal Reserve has expanded its balance sheet by over $8 trillion since 2008. And currencies around the world are engaged in what Dalio calls competitive devaluation, a race to the bottom where every nation prints more money to stay competitive. This is exactly why Dalio's warning matters now. Because gold and silver aren't just rising, they're sending a message about what's coming. First, Dalio believes gold and silver are signaling the inevitable debasement of fiat currencies, and this will lead to a fundamental repricing of wealth across the global economy. Here's what that means in plain terms. When central banks print money, they're not creating wealth. They're diluting the value of every dollar, euro, or yen already in existence. It's the same principle as diluting a company's stock through endless share issuances. The pie gets bigger, but each slice gets smaller. And for years, governments have been able to mask this debasement through financial engineering, low interest rates, and relatively stable consumer prices. But gold doesn't lie. Gold is truth. As Dalio puts it, chash is trash. He first said this in 2019, and he's repeated it consistently ever since. Why? Because holding cash in an era of negative real interest rates, where inflation exceeds the return on savings, is guaranteed wealth destruction. Every year you hold cash, you lose purchasing power. But gold, Gold maintains its purchasing power across centuries. An ounce of gold bought roughly the same amount of goods in ancient Rome as it does today. That's not magic. That's mathematics. Look at what's happening right now. In 2023, central banks purchased over 1,000 metric tons of gold, the highest level in 55 years. China's central bank has been buying gold every month for over 2 years straight. Russia, India, Turkey, all accumulating gold reserves at record pace. So what happens if the world's most powerful financial institutions are betting against their own currencies? What happens when the gatekeepers of the system itself are hedging with precious metals? This means if you're holding the majority of your wealth in cash or cash equivalents, savings accounts, money market funds, short-term bonds, you could face a silent confiscation of wealth, not through taxation, through debasement. Your account balance might show the same number, but what that number buys in 2027 or 2028 could be dramatically less than what it buys today. And here's the pattern interrupt most people miss. This isn't a future threat. It's already happening. Real wages, adjusted for true inflation, have been declining for years. Gold's rise isn't speculation. It's a mirror reflecting currency failure. But here's where it gets more complex. Gold and silver aren't just responding to monetary policy. They're responding to geopolitical fractures that threaten the entire architecture of the global financial system. On top of currency debasement, Dalio has been warning about what he calls the changing world order. In his book of the same name, he details how empires rise and fall in predictable patterns. Economic dominance leads to reserve currency status. Reserve currency status leads to excessive debt accumulation. Excessive debt leads to money printing. Money printing leads to loss of confidence. And loss of confidence leads to a new power taking the throne. Right now, the US dollar represents roughly 58% of global reserve currency holdings, down from over 70% just 2 decades ago. China, Russia, and the BRICS nations are actively working to create alternative payment systems, trade agreements denominated in local currencies, and financial infrastructure that bypasses the dollar entirely. When Saudi Arabia, America's oldest Middle Eastern ally, begins accepting yuan for oil sales, that's not just a trade deal. That's a seismic shift in the foundation of dollar dominance. And this is where gold becomes critical. In Dalio's framework, gold serves as neutral money, an asset no single nation controls, no central bank can print, and no government can devalue. As the world fragments into competing economic blocks, gold becomes the bridge currency, the universal store of value, the one asset every nation trusts when they don't trust each other. Consider this historical parallel. In the 1960s and early 1970s, as the U.S. ran massive deficits funding the Vietnam War and Great Society programs, foreign governments began redeeming dollars for gold at the official rate of 35 per ounce. By 1971, the gold drain forced President Nixon to close the gold window, effectively ending the Bretton Woods system and ushering in the era of pure fiat currency. Gold's price soared from 35 to over 850 by 1980. That's not a 10x return, that's a 24x return in less than a decade. So far, we've seen that gold is signaling currency debasement and geopolitical restructuring, which both point to a fundamental shift in how wealth is stored and measured globally. And that's not even the scariest part, because the third signal is the one most investors are completely unprepared for. Here's where we reach the core of Dalio's warning. Gold and silver are flashing red because they're pricing in systemic risk, the possibility that the interconnected global financial system itself faces a critical breakdown. Imagine it's late 2026 or early 2027. A major European bank fails due to exposure to commercial real estate debt. Panic spreads. Investors rush to withdraw deposits. But here's the problem in our modern fractional reserve banking system. Banks don't actually hold all depositor funds. They lend them out. When everyone wants their money simultaneously, the system freezes, counterparty risk explodes, credit markets seize. And suddenly, having a number on a screen means nothing if you can't access it, withdraw it, or use it. This is exactly what nearly happened in 2008, and Dalio was one of the few investors who saw it coming. In his daily observations at Bridgewater, he documented the cracks in the system. The over-leveraged banks, the toxic mortgage securities, the false sense of stability. When Lehman Brothers collapsed, it wasn't an isolated incident. It was a systemic event that required unprecedented government intervention, trillions in bailouts, zero interest rates, and quantitative easing that continues to this day. Now, nearly 2 decades later, the system is even more leveraged. Debt levels are higher, derivatives exposure is larger, and the interconnections between banks, shadow banks, pension funds, and sovereign nations create what Dalio calls the leverage trap: too much debt to pay down, too politically painful to allow deflation, and too dangerous to keep printing without consequences. This is where gold and silver become insurance. Not just inflation insurance, systemic insurance. When Ray Dalio recommends allocating 5–10% of a portfolio to gold, he's not making a speculative bet on price appreciation. He's reducing correlation risk. In his famous Holy Grail of investing, Dalio demonstrated that having 15–20 uncorrelated return streams dramatically reduces portfolio risk without sacrificing returns. And gold has a unique property. It often rises when nearly everything else is falling, especially during periods of systemic stress. Look at the data. During the 2008 financial crisis, while stocks collapsed by 50% and real estate imploded, gold fell initially but then surged 25% as central banks responded with unlimited money printing. During the 2020 COVID crash, gold hit all-time highs as governments unleashed 10 trillion in stimulus globally. The pattern is clear. When the system breaks, gold protects. But Dalio takes this a step further. He doesn't just own physical gold, he owns gold mines, he owns inflation-protected bonds. He maintains a truly diversified portfolio because, as he puts it, if you don't know the future, you need to be prepared for all scenarios. The window to act is narrowing, not because gold will necessarily skyrocket tomorrow, but because once the crisis begins, it's too late to position. Once banks restrict withdrawals, once capital controls are imposed, once the truly deflationary or hyperinflationary event unfolds, you can't reposition. You're locked in. And here's the actionable framework directly from Dalio's Principles. Step 1. Allocate 5–10% of your portfolio to physical gold or gold-backed securities. Not gold stocks initially. They carry company-specific risk. Start with the metal itself or highly liquid ETFs backed by physical gold like GLD or IAU. Step 2. Consider silver as a leveraged play on the same thesis. Silver has industrial applications, making it both a monetary metal and a commodity. Historically, when gold moves, silver moves faster, sometimes 2–3x the percentage gains. Step 3. Reduce exposure to long-duration bonds and cash holdings. In Dalio's all-weather portfolio, he dramatically reduced traditional 60-40 stock bond allocations in favor of assets that perform across multiple economic environments. Step 4. Diversify geographically and across asset classes. Hold some wealth outside the banking system. Own real assets, real estate, productive land, even collectibles. The goal isn't to time the market perfectly. The goal is to survive and thrive regardless of which scenario unfolds. The knowledge is here. The signal is clear. What separates those who preserve wealth through major transitions and those who lose everything is simple preparation, not panic, not paralysis, preparation. Ultimately, what does this all mean? Ray Dalio's warning about gold and silver isn't a prophecy of doom. It's a call to understand reality, to read the signals that markets are sending. to recognize that we're living through one of those rare historical moments when the rules of money itself are being rewritten. Gold and silver are rising not because investors are irrational, but because they're rational. They see unsustainable debt. They see currency debasement. They see geopolitical fragmentation. And they see a financial system built on leverage and faith, both of which are eroding. This isn't about abandoning modern assets or living in a bunker. This is about balance, about owning the assets that perform when paper promises fail. In short, Dalio's message is this: diversify radically, hold real assets, and understand that cash is not safety, it's risk disguised as stability. If you prepare now, if you allocate a meaningful portion of your wealth to precious metals, reduce overexposure to financial assets dependent on continued system stability, and build true diversification, you could not only preserve your wealth through the coming transition, but potentially position yourself to acquire assets at generational lows when others are forced to sell. If not, if you remain fully invested in traditional portfolios concentrated in stocks and bonds, holding excess cash, assuming the system will simply continue as it has, you risk facing the same fate as those who ignored warnings before every major financial reset in history. Remember, Ray Dalio doesn't predict crashes to be dramatic. He studies cycles, and cycles always turn. The long-term debt cycle we're in now has only two historical precedents in the modern era: the Great Depression and the period of stagflation and restructuring in the 1970s. Both times, gold multiplied wealth for those who held it. Both times, those who trusted in paper promises alone suffered devastating losses. The overarching philosophy Dalio lives by is simple but profound: bet on the reality of economic cycles, maintain radical diversification, and adapt as conditions change. Gold and silver are not relics of the past. They're insurance for the future. They're the message the market is sending to anyone willing to listen. The data is clear. The historical pattern is undeniable. The signal is flashing red. The knowledge is yours. Now it's about execution. What's your take on this? Are you already holding gold and silver, or are you positioned differently? How much of your portfolio is protected against currency debasement and systemic risk? Let us know in the comments below. I read every response, and we can learn from each other's strategies. If you found this breakdown valuable and want more insights from the world's top investors, Ray Dalio, Warren Buffett, Howard Marks, and others, hit that subscribe button. Every week, we decode the strategies that billionaires use to protect and grow wealth, and break them down so you can apply these principles to your own portfolio. Next time, we'll explore the one asset class Dalio says could outperform everything in 2026. And it's not what most people expect. You won't want to miss it. Until then, stay informed, stay diversified, and remember, the best time to prepare for a storm is before it arrives.
Thank you for watching. Please subscribe.